If you're losing trades, it's not bad luck. It's because you're blind to order blocks. Order blocks are where big banks execute massive trades, often leaving everyday traders like you behind. And so in this video, I'll be discussing what are order blocks, how to find order blocks, 3 crucial rules for finding valid order blocks, and a proven order block trading strategy so you can get better entries and bank consistent profits. Starting with, what are order blocks? Well, most retail traders, so everyday people, don't really move the markets, especially as they're dealing with a few thousand or a couple million. The real players that move the markets are the big banks, institutions, and hedge funds, especially as they're trading hundreds of millions. So when they enter or exit the markets, that's when we see the big moves. Now, these big players don't just enter trades randomly. They do so at special areas called order blocks. And this is where price pauses or has a consolidation. It's where these institutions are quietly buying or selling before the big move up. And in this area, there's usually a large amount of resting orders waiting to be triggered. And that's why when price reaches an order block, there's often a strong reaction or a bounce. So why do order blocks matter? Well, order blocks are important to help you find better trading entries. So instead of chasing price, you wait for price to come to you. See, it's all about trading with smart money, not against it. And now that you understand the basics of order blocks, you still need to know how to identify it. The first step is to find an impulsive move. And this is what we call an inefficiency. Price made a huge move with large volume, indicating that smart money entered the trade and filled in their big orders. And often price comes back down to fill in this inefficiency. The next step is to identify the last candle before the impulsive move. And in a bullish scenario, this is usually the red or bearish candle before the impulsive move. This is where big money are buying from. Similarly, in a bearish scenario, the last candle before the impulsive move is usually the green candle, and this is where big money are selling from. Then you mark the high and low of that last candle. So for the bullish scenario, you would draw the box from the top to bottom wick of the red candle. For the bearish scenario, you would draw the order block box from the top wick of the green candle to the bottom wick. However, not all order blocks are equal, and some have a higher probability of winning than others. And now that you've mastered finding order blocks, you still need to know these 3 crucial rules for finding valid order blocks. The first is a breakup structure. As you can see in this example, we have a clear uptrend with higher highs and higher lows. And each time, price has taken out the prior high, causing a breakup structure. And only once we have a breakup structure can we call it a valid order block. I can't tell you the countless number of clients that have come to me for help who get stopped out of a trade only to later realize that they didn't check for a valid breakup structure. Without a valid breakup structure, we do not have a valid order block. Also remember, there has to be a confirmed candle close above the high for it to be a valid breakup structure. If it's just a wick, it doesn't count, because that could just be a liquidity grab. Also remember to trade pro-trend, because many traders trade bearish order blocks, which is counter to the overall uptrend. And this is really just to maximize your chances of winning. Next, you have to find an imbalance, also known as an inefficiency. And this just suggests that there was huge momentum behind the move and that smart money was likely involved. And to find an imbalance, you have to take the subject candle, which in this scenario is the green candle. And as you can see, there is a gap between the right neighboring green candle's bottom wick and the left red candle's top wick. And this gap is called an imbalance. And this just increases the likelihood of price returning to the order block. And from my experience, order blocks which have an imbalance just have a high probability of winning as well. In this example, there is no gap or inefficiency. As you can see, we have the subject candle, which is the green candle, and there's no gap between the right candle's bottom wick and the left candle's top wick. And therefore, this is an invalid order block. The third rule of order blocks is that they are one-time use. And in this example, you can see we have a gap or an inefficiency. And so this is an unmitigated order block, and so can be used for future trading opportunities if price returns to the order block, especially as we have an unmitigated order block. In this example, you can see price touches the order block, leaving behind no gap or inefficiency, and then continues further up. And so we would not be interested in future trading opportunities as we have a mitigated and invalid order block. Now that you understand how to find high probability order blocks, I'm going to show you a proven order block trading strategy to tie these concepts discussed so far together. Let's start off with the diagram before moving on to real-life trade chart examples. Firstly, let's look at a bullish scenario. As you can see, we have lower lows and lower highs, indicating a downtrend. Then we had this higher high, which took out the previous lower high, causing a structural shift. So now we would then go through the checklist that we discussed earlier for actually entering a trade. The first step is to check for a break of structure, which we have in this case. Then we would check for an imbalance. After that, we would mark an order block, as you can see here. And for actually entering the trade, we would put a limit entry at the top of the order block, stop loss a couple of pips below the structural low. And for take profit, you can use my SSL framework. So structural, meaning any order block to the upside or any imbalance. Static, meaning a fixed 1:3 or 1:4 risk-reward ratio, or even liquidity, so local highs or local lows. Looking at a bearish scenario, you can see we had higher highs and higher lows, and then this lower low, which caused a structural shift, taking out the prior lows. And so we have the start of a downtrend here, and so would be looking for a short position. So like before, we would start by looking for a break of structure, which we have, then an imbalance, and then after, mark the order block. For actually entering the trade, we would put a limit entry at the bottom of the order block, stop loss above structural high, and we would wait for price to come back to the order block and fill in our entry. So this is an example of a recent live trade given to my students in real time in my training program. And on the Euro USD chart, we had a massive sell-off on the daily time frame. And then on the 4-hour chart, we had this impulsive move up, which took out the prior lower high here. And so following the rules of the checklist discussed earlier, we would check for a break of structure first. You can see here, there is a break of structure like this, especially as we have a close above this high. Then I looked for an imbalance. So again, taking this candle as the subject candle, the neighboring right candle has a bottom wick, which does not meet the top wick of the left neighboring candle. And so therefore we have an imbalance or inefficiency. And so if we drew an order block, it would be a valid one. The next step is to actually mark the order block. And so in this situation, I actually marked this green candle as the order block, as for me, this was the last candle before the impulsive move up. And usually the order block in the case of an uptrend is the red bearish candle. But what's more important is that it's the last candle before the impulsive move. Next is to put the limit entry. And so we would put a limit entry at the top of the demand zone. The stop loss, you can put a couple of pips below the low. Another option also is to put the stop loss at this overall low here. But a potential downside of that is that the risk-reward ratio would be substantially diminished. So I just put a couple of pips below the low. For take profit, I aimed for local structure. And so looking to the upside, we do have liquidity here to aim for, but the risk-reward ratio was not great. And so I ended up aiming for this local order block here. And this was a solid 1 to 3.54 risk-reward ratio. So let's see what happened next. So the entry got triggered and actually ended up hitting the take profit and continued much further up due to NFP news event. And to be honest, initially I was disappointed, especially as I did not catch this entire move. But expectations are the enemy of the market. And the main thing is having a plan and sticking to it. There will always be profits left on the table. And it's important to be aware of what's within your control. Let's look at another example of a recent trade using the strategy, but this time on the 1-hour Australian dollar Swiss franc chart. And on the 4-hour chart, there was a massive downtrend. But then on the 1-hour chart, we had this huge impulsive move, which took out the prior highs, giving rise to a trading opportunity. So let's go through the trading checklist. So we would first look for a break of structure, which we have. So we would mark break of structure here, or change of character. This impulsive move caused a structural shift. The next step is to check for an imbalance. This long green candle is the subject candle. And as you can see, there is a gap between the bottom wick of the right neighboring candle and the top wick of the left neighboring candle. And so we have an imbalance or inefficiency. So we can look for a valid order block to trade from. The next step is to mark the order block on the last candle before the impulsive move. And so I marked the order block here. So this was the last candle before the impulsive move up. So now we can put a limit entry at the top of the order block. So like this. The stop loss you can put below this bottom wick here. But personally, I prefer putting it below the major structural low here, especially for the lower time frames, just to give more breathing room for the trade to play out. The take profit I put near this liquidity here. Now let's see what happened next. So as you can see, price triggered in our entry, but let's see if it hit the take profit. Now bear in mind, this entry was triggered on the 11th of April. Price did not really hit the take profit for a long time. And actually a week later, I closed the trade early. So it did not quite reach the full target, but there was a major approaching news event. And also, I wanted to free up margin for a better trading opportunity. So I exited the trade in just over a 1 to 2.2 hour profit. But then what happened next was interesting. The price still did not have much progress and actually ended up hitting the take profit 2 weeks later from our initial entry position. And so whilst I did not catch this full move, for full transparency, this trading strategy still played out and the principles still apply. So these chart examples just illustrate the dynamic nature of the strategy, especially as it can be applied to multiple time frames and asset classes. Of course, there are many different entry styles for the strategy, and here are the three main types. The first entry type is the risk entry. And taking this example, we have a downtrend. And as before, we would mark the break of structure, check for an imbalance, and then draw an order block. We would then put a limit entry at the bottom of the order block and the stop loss a couple of pips above the high. The main advantage of the risk entry is that there is a higher probability of the trade being filled. But a potential downside is that price could go straight past and hit your stop loss. The next entry type is midpoint entry. And for this, we take the same order block, but enter at the midpoint. So improving the risk-reward ratio. But a potential downside is that you risk missing the trade. Of course, you also have the confirmation entry. And for this, we would drop down to the lower time frames. So from the 4 to potentially the 15-minute chart. You would enter at the bottom of the 15-minute order block in the case of a downtrend, and the stop loss would be a couple of pips above the high. A major advantage of this is that you have more control for your entries, and the risk-reward ratio is substantially better. But there is a risk you could miss your entry, which is the price to pay. Over the years, I've tested all kinds of entries. I'm a bit of a scientist. And one of the common questions that I get asked by clients all the time is, which entry type is the best? The real truth is that there's no one-size-fits-all answer. It all comes down to your personality and risk tolerance. Personally, I prefer to use the limit or risk entry approach for swing setups. But if I'm less confident, then I will wait for low time frame confirmation. What really matters is that you backtest and track your trades to find out what works best for you. After all, men lie, women lie, but numbers don't. And now that you've learned about order blocks, you still need to learn about supply and demand to be a profitable trader. So check out my previous video to learn more about that.